Is your portfolio bleeding, or are you just looking at the wrong cards? Hi, I am Paul. In the last few weeks, we've seen stocks wobble and gold take a sudden hit. If you've looked at your headlines lately, market peak, recession incoming, is gold dead, or software apocalypse, it feels like the financial media is trying to sell us a horror movie once every few weeks. But here's the secret. In the past 5 years, the world ended for countless times. From the COVID-19 outbreak, wars in Ukraine and Middle East, the AI bubble, US hard landing or government shutdown, or the fear of US Treasury default. And yet, almost every major asset class were up, and then finished in the green. So does 2025, if you're feeling the volatility of early 2026, it's not because the market is broken. It's because your decision or emotion has been steered by news or social media, or those market noises who just want to attract more views or likes. To not repeat mistakes or miss those hidden gems, we are going deep into the 2025 playbook and try to understand how the smart money, the real global players, ate from every corner of the world while the house was supposedly on fire. Grab your coffee, pull up a chair, and let's look at the cards everyone else may miss. If 2025 taught us one thing, is that broad market indices such as S&P 500 or Nasdaq are absolute masters at hiding the truth. History will record last year as the Great Decoupling. On paper, the S&P 500 looked great, surging plus 17.9%. Yes, your wallet is swelling, but the US market was actually the underdog comparing others. While your friend Kevin was bragging about his index fund, it was actually an underdog compared to international peers. Of course, we should not be greedy to earn every single penny. But it doesn't mean that we should be all in on Magnificent 7 or AI or any specific sector or country. Let's talk about April 2nd, 2025, a day the administration called Liberation Day. Most traders remember as capitulation, which means a mass panic selling by investors during a market downturn to just stop bigger loss or pain. The US announced a universal 10% tariff, and let's not forget that massive 100% hit on China. The VIX, the market's fear indicator, spiked to 34. Global equities shed over 11% in a heartbeat. While investors were panic selling, corporate lobbying at the White House spiked 400%. From the lobbying data, the big players could sense that the strategic tech exemption from tariff was coming. On May 10th, when the exemption for smartphones, computers, and chips dropped, the market ripped higher and erased all those apocalypse losses in a month. What is the lesson? In a politicized market, the news is a distraction sometimes. Also, news is backward-looking, but great investors look forward with visions and insights. Look at the data. After the Liberation Day dip on April 9th, 2025, the market PE, price over earnings, dropped to levels that close to the capitulation from the COVID-19 outbreak. As an investor, should we consider that the tariff impact would be more devastating than a pandemic that stopped the entire world and killed thousands of people? For those who saw the logic, it was the perfect spot to buy in and ride that 36% recovery through the end of the year. How do we spot these fake outs in 2026? We follow the news, but we have to think 2 steps ahead, like playing chess. Over the past few weeks, did we make the same mistake again with Greenland or Donald Trump's war threat between the US and Europe? While the US Treasury and US dollars were acting like a fragile giant, the other asset markets staged a robust year in 2025. In Q4, we hit the longest government shutdown in US history, 43 days. The US dollar index, the DXY, didn't just fall, it had collapsed by 9%. This wasn't a glitch, it was a structural rebuke of US debt to GDP. This fueled the US debasement trade. While politicians argued over seating charts in DC, gold was riding the plane, finishing up 80.2% up last year. And silver, the hybrid monster of money and industry, it rocketed up by 149.1%. Thanks for raising political and geopolitical tensions, wealthy investors, institutions, and governments, which expect more conflicts with the US in the coming 3 years. May all join the game of debasement trades to relocate part of their US assets for others. Gold is one of the great choices, so it became the winner of 2025 with zero doubt. Now we may think that after Russia and China, will Europe also diversify to other assets or keep piling investment on the US in 2026? Now look at the Foundry twins. If you wanted to see where the real party was in 2025, you had to fly to Seoul and Taipei. South Korea's Kospi index was the undisputed champion, returning a staggering 76% up. Why? Because they hold the plumbing for the AI supercycle. SK Hynix surged 268%. They sells the high bandwidth memory, so-called HBM, that actually powers AI to actually learn and think. Another key point is that their capacity was sold out through 2027. Taiwan followed suit with 67.4% up. TSMC, the world's top one semiconductor manufacturer, TSMC surged 44% simply because AI players are craving for chips. And Taiwan's TSMC is the only one with the kitchen in advanced logic chips and other AI chips. The takeaway for 2026? In current stage of the AI revolution, the producers of the physical stack, such as hardware companies, miners, earn real cash. Companies such as software as a service, chatbots such as OpenAI, or selling dreams but no real profitable business yet, may not be the most popular spots. And then there is Japan. Forget the old weak yen playbook. 2025 was about domestic reflation. For Japan, for the first time in 33 years, Shunto wage, meaning Japan's annual wage negotiations, growth hit 5.5%. This is incredible! Also, we have witnessed that Japanese investors and global players were to buy the recovery, leading to another promising year for the Japanese market, and the Topix index finished 25.5% higher. We also saw history in the making with the election of Sanae Takaichi as Japan's first female prime minister. She's been called Japan's Iron Lady, and her Sanae-nomics framework doubled down on public spending and expansionary policy. Warren Buffett buying Japanese banks wasn't a fluke. It was like your grandfather finding a vintage Rolex at a garage, but sold for $5. Warren Buffett saw the reflation coming before the rest of the world woke up. So far, Warren Buffett and other global players have enjoyed another stellar year on Japan market, such as Japan financial sectors, and the AI names also popped up as a surprise, due to rate hikes and increasing investment activities. What is the risk for 2026? How will the first female Prime Minister, Takaichi, and her supermajority cabinet guide the nation after the landslide election victory, as the country's strongest leader since Shinzo Abe? Back in the States, the Magnificent Seven monolith finally fractured. It wasn't a breakup, it was a conscious uncoupling. Look at the chart. Only Nvidia and Google significantly outperformed the broad index. Tesla and Apple lagged, showing that the market has decelerated on rewarding AI hype and started demanding AI execution and real earnings rather than dreams accompanied with huge debts. Investors are moving from the Ask ChatGPT a question era into the how do we monetize AI investment era. If you aren't showing the money, the market isn't showing the love. Yes, if you still remember that Oracle stock dropped 13% in a week not long ago due to their 5-year credit default swaps raising concern over the massive AI spending. The AI supercycle, driven by Blackwell ramps and HBM shortages, is extending past 2027, proving that in a power-constrained world, infrastructure beats chatbots. At least for now. If you want to be a world-class player, stop going all in and start looking at rotation and diversification. Now the example is the shift from software or chatbot AI to the pick and shovel phase. Hyperscaler CapEx. The money giants like Amazon and Microsoft are spending hit over $380 billion. But where did it go? It went straight into the bottlenecks. We call this scarcity as a service. When SK Hynix says they are sold out of HBM memory and TSMC says the Blackwell GPU ramp is constrained, they aren't just giving updates. They are showing you who has the pricing power. Korea's SK Hynix finished the year up 268%. This is scarcity as a service. When supply is the only thing that matters, the producers hold all the cards. The trade extended far beyond chips into the boring stuff. While some people was dating the AI chatbot, some investors already moved attentions to the upstream opportunity on the AI chain, such as the liquid cooling radiator. But most people just sensed it from the news or friends recently. Physical constraints drove the real alpha. AI software only saw modest gains of 15 to 20%, but storage was the breakout star. Western Digital surged nearly 300% after its pure play split, and Seagate hit 228% indices. Why? Because as AI moves from training to inference, the amount of data we need to archive is exploding. You can't run a digital revolution on a broken grid or a full hard drive. Boring hardware is the new growth engine. This is not the recommendation to hardware companies. Instead of chasing the news or absolute return, focus more on the risk-adjusted return. Because none of us has a crystal ball for the next hardware bottleneck. Nevertheless, who knows? The next algorithm or software design breakthrough can slice down the hardware demand. Global banks became the premier value trade of 2025. For years, these were the dogs of the market. But with the yield curve finally inverting and AI driving internal efficiency, return on equity, ROE, jumped into the 11 to 25% range. US banks rose by 32%, Euro stocks banks hit a record 76% increase. Japan banks rose by 45% on the back of BOJ hikes. If you were still overly scared of the 2023 regional bank run in the US, you missed the forest for the trees. Higher for longer rates and a revival in M&A have turned these laggards into leaders in 2025. In 2026, we can see both headwind and tailwind on higher for longer rates. While central banks try to balance between economic growth, hiking inflation, and growing fiscal spending. We also learned that central bank accumulation and debt hedging make gold and silver the ultimate hedges against fiscal dominance. While gold saw a solid 80% increase, silver was the breakout star at 149% up. This wasn't just central banks playing. Industrial scarcity in electronics combined with monetary debasement created a perfect tailwind. For 2026, the debasement trade may go on. As long as debt levels climb, these hard assets are insurances on eyes of some investors. Finally, the China is dead fallacy. When the reports and news told you that China was an uninvestable over the past 2 to 3 years, after years of underperforming and rounds of regulatory overhauls, including the double reduction policy on education, the 3 red lines on real estate, anti-monopoly and data rules on tech leaders, gaming limit, compensation cap on banking, fintech regulation, zero COVID policy, etc., that fear finally turned a generational entry point. While the US market was priced for perfection at 22 times earnings, China was on the clearance rack at 9 times. Everything changed in January 2025. The release of DeepSeek R1 was China's moment. It proved China could build an elite AI despite sanctions on the best GPU. That sparked a massive global re-rating, and the Hang Seng Tech Index ripped 41% higher. We've seen 5 years of iron fist revamping the markets across sectors, but that era seems over. Staying on the sidelines isn't just a choice anymore. Don't underestimate the power of capital and humans' resilience. As nothing will rally forever, nothing will be bearish forever. Recently, the broad China market index seems stabilized and lacking another stimulus to grow further. However, those frontier AI-related names have been rocketing, and these names were not under the spot of many investors as people only focus on the largest names such as Tencent and Alibaba. So, how do we play the rest of 2026? First, fade the apocalypse. We just saw the Greenland crisis in January, where the administration threatened 25% tariffs on European allies. The headline screamed, "War in the Atlantic." But by January 21st at Davos, we had access without annexation. The world rarely ends on the timeline the consensus expects. Being cautious to go bearish on the market easily, especially in the long run. Second, watch the plumbing. Passive flows distort everything, not just the spreadsheet models, but also the value investors' beliefs. Don't underestimate the power of retail investors as 400 billion in ETF flows. Third, hedge fiscal dominance. Maintain your exposure to hard assets. Powerful voices want lower rates and a specific dollar trajectory. Passive beta is no longer sufficient. For those who can read the pipes, structural alpha is very much alive. One last thing! This report and all associated content are provided for informational and educational purposes only and do not constitute investment advice. You are solely responsible for your own research and due diligence. Crestjury Capital Lab, the pub of Queen's Road and its affiliates accept no liability for financial losses resulting from this information.